Hello traders, in this video we're going to be discussing the S&P 500, the Russell 2000 or US 2000, the Nasdaq 100, and more importantly discussing market capitalization of the top 5 companies in the S&P 500. We have never seen those top 5 companies be as large as they are, make up as much as they do as a percentage of the US 500, and more importantly, why is it that we are seeing the US 2000 lag behind the other indexes? There's much to learn in this video, and we'll see you right after this intro. Okay, I'd just like to remind everybody to like the video, comment down below if you have any questions. Of course, subscribe and smash that little alarm button so that you get alerts directly to your mailbox. Also, consider joining our free public Telegram group where you and other traders can discuss current setups. Okay, well, before all of this flash crashing started back in late February into March, the Russell 2000 was actually sitting at above 1700. Then what happened is, of course, it fell off an absolute cliff, nosedived under even 1,000. And then while we have seen a recent recovery, this recent recovery shows and paints a different picture to what I think a lot of people are expecting. If we compare this with the US 500, we'll notice that the crash followed by the uptick has been a lot more prominent in the S&P 500. This particular market has almost recovered all the way back to where it was last year in October. So an incredible recovery on the S&P 500. The Russell 2000 has not done so, and the Nasdaq has actually recovered all the way till the end of last year. So it's really only just wiped off the start of year gains. So some massive recoveries in certain indices. So what is the Russell 2000 telling us? Well, the Russell 2000 is made up, of course, of 2,000 companies. And those 2,000 companies have there's a lot of small ones in there. There's not just huge multinational, giant global companies. There's a lot of companies that are going to be suffering through this crisis. The recovery makes sense because we're going to load up a few key charts here, and we're going to discuss why these companies aren't coming back and what this could mean as a future lead indicator for the US economy as a whole. Okay, so here's the first chart. Most important things about this chart, and of course this is provided by BofA Global Investment Strategy at Bloomberg, is the 2000 highs versus where we are now. So while the 5 largest stocks have changed over the last couple of decades, is that coming into this crash, we have an incredible saturation in the top S&P 500 companies. Look at the company brands there: GE, Microsoft, Cisco, Intel, Walmart. Still all very large companies. Of course, GE has fallen off a lot in recent years, but these are still relatively household names. Everyone knows what Walmart is. Everyone knows who Intel are. Most people know who Cisco is. And of course, Microsoft is incredibly well known. So massive saturation coming into a big sell-off. And then we can see the capitalization of the largest companies wasn't actually that large until recent times. Now with the tech boom and of course the smartphone boom, we saw companies like Apple, Amazon, Alphabet or Google, and Facebook come into prominence. And these have done very well during this current crisis. They've done amazingly well, at least theoretically, from a perspective of people moving online. They are in the internet space. The internet space will do better during this period. But the most important thing is these companies don't represent the overall economic impacts. They just represent the fact that there are 5 companies that make up 20% of the S&P 500. Let's now take a look at this market cap size when we compare it to the average over the last 45 years. As we can see here, the average should be around 14%. We're now at all-time 20% plus levels. So a significant disparity between the large companies and of course the smaller companies in the S&P 500, let alone the Russell 2000. Then what we want to do is bring up this really great chart from Goldman Sachs Global Investment Research, and this particular one shows some very key points. I'll highlight these key points for you now. The first one is these are all the different subsections of the S&P 500. If we look at the distance below the 52-week high, 28% in terms of is the median from the 52-week high. So if we're looking or thinking about those companies like Amazon, which is at all-time highs, that isn't making up anywhere near this 28% away from the 52-week high. They're at all-time highs. So are many of those large cap companies. And it starts to paint a picture of the problems in the US economy. Consumer discretionary, we would always feel that is going to be the most hit area outside of course, what we're seeing with energy and tourism. But consumer discretionary, people just aren't spending. They're not buying as much. They might be buying staples, which is why we're seeing staples not being very low, things like Costco, supermarkets, that kind of stuff. But discretionary is hugely down across the board. Consumer staples doing relatively all right. Healthcare obviously doing relatively all right. Real estate really suffering here. Materials suffering. Communication services suffering. Infotech, depending on the particular company, suffering and not suffering. Energy getting obliterated, with oil, of course, going below $0 on one of the futures contracts last week. And then even financials coming under a lot of pain. So when we actually break down the S&P 500 and we think about which sections are doing well, outside of those top 5 companies, not that many are doing well. There's only a few sections that are doing well, being that of the healthcare and that of the consumer staples and some infotech companies. The rest are really still suffering. In fact, consumer discretionary, it just may not recover for a very long period of time. So it starts to paint a picture where we say, well, if this is what's happening and we've only got 5 or 6 or 7 or maybe 50 to 100 companies in the S&P 500 doing relatively okay, what about that Russell 2000? Will those companies actually get the stimulus checks that have been sent out? Will these companies be able to recover? There was a Harvard study that said only 56% of companies that do come out of crisis actually recover back to their previous earnings, and it takes 3 years for them to do so. A lot of them will go bankrupt, and a lot of these back in 2000 index companies won't get the stimulus checks. So this is what's going to become the story over the next coming months. The Russell 2000 is already showing us that the US economy is not doing well. Obviously, it doesn't take a rocket scientist to know that, but it's showing you that severe fear in the back end. And if stimulus checks, stimulus regimes, all these things don't get to these companies, it could trigger a wave of defaults that goes through and becomes a serious financial crisis. So I think the Russell 2000 paints the picture of what could be to come. And unless these companies are getting what they need and the support that they need, we could be facing serious bad times in the future. I'll bring up this last chart just to end with. This is from Reuters. And basically we can see here, US economy faces historic shock with 16% joblessness possible, and Trump advisor says. Now a Trump advisor is saying this and he's saying 16%. I've seen as much as 30%, and that may be a bit extreme, but that was coming from Yellen, who actually was a Fed chairman. So there are some wild numbers in terms of unemployment, and unfortunately this probably won't go away tomorrow. As we saw in one of our other videos, which I'll link down below, effectively it looks like most crashes, most recessions, the way that it works is minimum 1.8 years back to the peak. If we're already seeing the NASDAQ already at the peak, that's incredibly unusual. It could mean overvaluation in the top 5 companies, and based on some of the charts we've seen in this video, it would make some sense. So look to the Russell 2000 for a bit of a key on what the back end companies are doing in the US. And we need to be very careful with those top 5 companies. As I said, over 20% of the entire S&P rests on those companies' shoulders. We must see earnings reports, and they have to knock it out of the ballpark because evaluations are probably too high on them. Obviously, we'll have to see what happens, and we'll see you in another video.